Hello and welcome. You're tuned into CNBC-TV18 Prime. Let's get cracking on a brand new edition of The Big C. I'm Manisha Gupta, back with your daily dose of commodities, cryptos and currencies. We'll decode the global commodity narrative as it unfolds amid tariffs, fears and macro uncertainty. Joining us on The Big C today is Iman Nasseri. He's FGE NexantECA. We will also be joined by BHP top boss Ragnar. But before we deep dive into those conversations, let's take a quick look at the global markets first. And stocks on Wall Street coming off a mixed session amid a largely risk-off session. The S&P 500 and Nasdaq lock cuts of around 0.6% and 1.5% respectively. Meanwhile, it was the Dow Jones that managed to eke out thin gains, largely aided by earnings. Cues on deck, all eyes on minutes from the July Fed meeting ahead of the Chairman Powell's speech at the Jackson Hole meeting. I mean, that is the thing that is most awaited and closely watched at this point in time. The stocks in the Asia Pacific are tracking that mixed print from Wall Street. The Japanese Nikkei taking a sharp knock after exports logged the steepest drop in over 4 years. Meanwhile, the Shanghai extending gains following the PBOC leaving the key lending rate steady for the month of August, for the third straight month, by the way. Back home, the trade on Dalal Street is taking shape at the lunch hour. Nifty is above 25,000 mark at a day's high right now. And shifting focus to the crude oil prices, after that 1% decline overnight, the prices seem to be picking up amid supply concerns as the peace talks between warring Russia and Ukraine are taking longer than expected. The move, therefore, leaves in place sanctions on Russia crude and raises prospects of further curbs on the buyers. Moving on, Treasury Secretary Scott Bessent says that the Trump talks with the European Union leaders and Zelensky yielded a good outcome and spoke on why Russian leader Putin wants the war to end amid the economic impact. Let's listen in.
Both sides are ready for this terrible conflict to end, and one of the ways to make President Putin want it to end is on the economic side. The Russian economy has 20% plus inflation. Right now, it is a war economy. I think more than 25% of the GDP is coming from the military buildup. So, you know, it's a very imbalanced economy. They're the frozen Russian assets. The runoff from those is now being used to finance the war. So, you know, there are a lot of moving pieces here, Joe.
The Treasury Secretary added that India is profiteering by buying Russian oil and says India and China's situation on oil purchase is not the same. Listen in.
If you go back and look now, I believe India had less than 1% of their oil, 1%, and now I believe it's up to 42. So wow. India is just profiteering, or they are just profiteering. They are reselling. They've made $16 billion in excess profits, some of the richest families in India. So you know, this is a completely different thing. Like this India, what I would call the Indian arbitrage, buying cheap Russian oil, reselling it as product, has just sprung up during the war, which is unacceptable.
Well, those are the statements coming in here from that interview yesterday. But joining us now is Iman Nasseri. He's MD Middle East Research, FGE NexantECA. Iman, I thank you so much for joining in. And you heard what the U.S. Secretary Bessent had to say. What is your reaction when especially the comment on India and China, when he says that both the countries are not comparable and India perhaps seems to be profiteering?
Well, there is some truth in that when you're dealing with free market, players in the market are going to maximize their profit by procuring the cheapest available suitable feedstock to produce their products, and they're going to sell to the market at highest possible price that they can sell. So there's nothing wrong with that. If the U.S. or other let's say organizations want to limit the trade, they have multiple tools that they have utilized. So I believe there are sanctions that and price cap that Indians are specifically are complying to those elements. But despite that, basically there is some moral side of it that perhaps Europeans or the US want some players to play with their moral ethics and standards, but not every country and every company, in my opinion, always play to the other party's moral standards. They play to their commercial interest as well as their own nation's moral standards. So yes, there are some truth in what has been happening, which is basically the market finds a place for everything, and there is always price that sets what goes where. China and India have been buying Russian, and in terms of China, they have also been buying some other sanctioned barrels from Iran and Venezuela. But it's not the country, it's the companies, and those are basically following the rules, regulations, and compliance, and basically trying to maximize their interests and benefits.
Oh, well, yes. Iman, a few conversations had happened, and now the world is watching, and if in actual that trilateral meeting happens between US and Russia and Ukraine, how are you looking at it as we get into that meeting? Perhaps the time and date is yet to be decided, but with the couple of meetings that have already happened, do you see any context changing at all?
No, not really. I mean, this is not the first time. Trump has been in the office for 7-8 months now, at least effectively, and he has made several efforts in terms of bringing peace and conversations. He has spoken with Putin separately. He has had Zelensky in his office. And yeah, maybe this is the first time that he's going to have both parties together joining a conversation. But the issue is bigger, in my opinion, and I am not necessarily very optimistic that we can get something. Wishful thinking, I hope that the war ends today, if not tomorrow. But realistically, looking at this, there are structural issues for both sides to continue what they have started over 2 years ago. And I think we're going to continue to see this situation. It's very hard to imagine an outcome that stops everything. And if it did, it's not going to be back to, let's say, before the conflict and the war began. There are many things that have changed, especially between Russia and Europe, that are going to stay regardless of the outcome of this trilateral meeting.
Iman, would you say that the worst is behind us? Because the market really seems to be pricing in a scenario where some good news perhaps could come in. Because with everything being thrown around at the market, we've seen the crude oil prices surprisingly very steady.
Yes, I have to say that the oil market has certainly lost part of its sensitivity to politics and geopolitics. A few years ago, many events that have happened over the past, specifically over the past 1 year, we have seen war, Iran, Israel, we have seen many other conflicts, India, Pakistan, the situation between Russia and Ukraine going up and down. And the oil market has been fairly steady in the historical context. And that's basically, in my opinion, lack of sensitivity or lower sensitivity to geopolitics. But yet you see the market interprets the headline. Yet you see the up and down, but it's in the order of $1 to $2 before. Things that were to the same extent as what we see today would have changed the price $5 to $10. Now it has come down to $1 to $2, $3, $4 max, and that's the reality that the market is facing. A lot of uncertainty. When you're in a certain situation, one uncertainty can create lots of distortions. But when you have multiple uncertainties, the impact of individual is diminished, basically, and that's where we are today.
Iman, you're calling the markets insensitive, and I would have to agree with that, really. But from here, where do you see the crude oil prices moving, really? Because are we going to be stuck between the 60 and 70? There's a lot of reports suggesting that we could be going sub 60 as well, and a worst case scenario perhaps towards 75. But nobody really seems to be believing that the crude oil prices will move out of that 55 to 75 range. What is your own sense?
I have to say that I agree in terms of range that, as I mentioned, there are so many uncertainties in front of us, both on the supply side as well as demand side. And the trade is basically only making situation worse, meaning that it puts some of the supply at risk and also because of the trade friction, some of the demand. So the range remains, as you mentioned, 55 to 75, with more perhaps risk to the downside, only because the elements of taking supply out of the market are less likely at this point in time. We have OPEC Plus in front of us, which has basically decided to bring back the first tranche of voluntary cuts almost in full by October. And then we have to wait and see what they do regarding the other cuts of the supply that they have out of the market. That's one possibility that could basically, if brought back into the market, could put downward pressure to the prices, more supply. We have Iran and Venezuelan barrels, which are basically pending to see what happens, and Trump keeps changing his decisions. And then obviously we have the Russia. And demand is basically subject to many other parameters here. Right now, we are in a high demand season. We're still in third quarter, and this is when the peak of demand is. And so prices remain supported. I think going into the fourth quarter, the market can still remain supported. But going into 2026, a lot of these uncertainties unfold, and basically the surplus expected to come on the current business as usual. Again, I repeat that business as usual is key here, meaning that if any of these key parameters and uncertainties change significantly, we could be in a totally different fundamental situation. In the current fundamentals of supply and demand, yes, the surplus into the market will increase in the first quarter next year, and that's when the prices are expected to go sub 60.
Iman, a final word on the crude products as well, because it's not just the crude oil prices which are going down. The overall energy sector seems to be slightly under pressure because, as you mentioned, this is the peak demand summer season. We are also looking at more than normal warmer temperatures in much of the part of that world. And even with that air conditioning demand and all the fundamentals there, we've seen natural gas prices continue to decline. Even the gasoline prices have been under pressure. Heating oil prices have been declining as well. When I look at the month of August and the last couple of months, by the way, it's all in the negative right now.
Yes, we are all, I mean, demand is in the product side. So we should, whenever we talk about the oil market and demand, we're talking about the collective demand of products. And there are seasonalities when we get into the 4Q, the winter season in the northern hemisphere basically increases the demand for heating oil, and when we're in the summer in the northern hemisphere, where most of the demand, oil demand globally exists, we're looking at fuels, transport fuels for driving and air travel during the summer holidays. When we go into the 4Q, as I mentioned, the demand is mostly responsive to temperature, and as you mentioned right now, the forecast suggests to a normal or warmer than normal winter, and that means that we may not have a strong demand for products for heating fuels. And that could also potentially, that's one of the uncertainties on the demand side that I mentioned, and could put pressure on product cracks and product prices. Natural gas is a competing fuel, and basically in many countries, the power sector decide between switching between oil and gas, depending on the price sensitivity, especially in Northern Asia, in Japan and Korea, for example. And that also responds to temperature and fuel demand for liquid fuel. So if demand for liquid fuel is low, that means pressure on switching to gas is low, and hence lower gas prices are expected in the winter. And that's where we are now. But as we have seen in the past, temperature forecasts are not the most reliable forecast. Suddenly we could see a quick cold snap, and then everything goes upside down.
Iman, thank you so much for joining in. Well, absolutely. As you said, there are lots of fundamentals and moving pieces to the puzzle that continue to weigh onto the markets here. But I take your point on the crude oil prices. 55 to 75 is the range that we are looking at. And well, yes, there's just so much to watch out for from where we stand at this point in time. Appreciate your time. Thank you so much for joining in and analyzing all of that for us. With that, it's time for a short breather. On the other side of the show, we will be joined by BHP's Ragnar with all things metal. Stay tuned. Welcome back. As promised, joining us now on the show is Ragnar at BHP. First of all, Rag, thank you so much for joining in. Overall FY25 numbers that you have recently released show a slight decline in profits. Where is this dent coming in from?
Thanks for having me today, Manisha. And overall, I'd say it's been a fantastic result for BHP this year. If you take a look at our performance, strong operational performance across most of our businesses, record production at our Western Australian iron ore business, copper production up 28% over the last 3 years across our business, costs down 5%. And what that's led to is basically 10.2 billion in profit, a 21% return on capital employed, and a 53% margin, which is about 10% greater than our next nearest competitor. All up, that's resulted in a 60% payout or 60 cents per share in terms of our dividend policy. But to your point, this is a cyclical industry, and we have seen some of our commodity prices down a little bit, which has resulted in that slight dip in profit that you mentioned.
The production numbers do look good on your report there, Rag. How do you see the copper and iron ore production going forward? Also, if you take a step back, how have the last 3 years been, and what is your guidance really for the coming year for both of these products?
Copper production has actually performed very well across our business, and that's been a real emphasis for us, both in terms of the future-facing commodities, looking at growth in copper and also in potash moving forward. And so we have a number of major growth projects across BHP, looking at potential options in Chile, Argentina, Copper South Australia, in Australia, obviously, and our Resolution copper deposit that's a joint venture deposit between BHP and Rio Tinto. So overall, very bullish on that. What we are seeing is we continue to believe that copper demand will increase from 32 million tons a year this year up to 50 million tons going out to 2050. So very bullish on that based on the ubiquitous nature of copper and the demand needs that we're seeing, whether that's through urbanization, decarbonization, or digitization.
That's about copper and potash, but what about the iron ore production numbers there?
Look, iron ore, we're very proud of where our business sits in terms of the profitability that it generates. So at the moment, that Western Australian iron ore business is producing about 290 million tons of iron ore a year. And compared to our next nearest competitor, we're generating about a $7 free cash flow per ton benefit, which all up comes fairly close to $2 billion a year in additional free cash flow that we're generating a year out of that business. Now, in the longer term, we do expect that we will see demand for steel sitting at about 0.6 growth globally. We expect that we will continue to see China at that billion-ton mark for the next couple of years before a gradual decline out towards the 2040s.
Rag, those are the production numbers, but when it comes to the cost of production, have those numbers gone up as well? We've been looking and talking about higher input costs or increase in wages therein because of the very volatile metal prices. Has it impacted your inputs?
Well, we've actually seen our cost of production, particularly at Escondida, come down quite a bit this year. A lot of that's been through the increase in volume and the dilution that comes across the fixed cost base as you produce more tons and cost actually coming out. The same is actually true at our Copper South Australia business. Manisha, what you are highlighting, though, is exactly right, that across the industry, what we are seeing is the supply of mines. Mines are getting deeper, they are getting older. As those mines get deeper, it means longer haul distances to get the material to the top. It means harder material that you're bringing to the top as well, and cost of production more generally will get higher across the industry, but that's leading into a very, very strong demand profile. So we're very bullish on copper in the longer term.
All right. And what is also your CapEx investment going forward and the spend on exploration? Because the last few years show an increase in growth there. Are you looking at that pattern continuing?
Well, at this point, we are just so blessed in terms of the number of organic growth options we have within our portfolio. So if I was to take a look at Chile as an example, we operate the Escondida copper mine in Chile that produces this year 1.3 million tons of copper a year. That is the world's largest copper mine and has been for a number of years. But it is blessed with an endowment of 26 billion tons of ore, greater than 0.53% copper. An immense opportunity to continue to expand that. Copper South Australia, we're looking to increase from 300,000 tons a year to 500,000 tons a year over the next 5 to 10 years. Vicuña in Argentina is looking like a top 10 potential copper deposit globally, and that's before we even talk about resolution. So from our standpoint, we think we have a very, very deep and rich portfolio of copper to actually bring forward for the world.
The other botheration clearly has been the tariffs, Rag, and have you seen that impact come in for you, for your companies, and the fact that we've seen a 50% of tariff come in for copper, steel and aluminum, has that impacted you in any sense?
So in terms of copper tariffs, we actually haven't seen an impact to our operations associated with that. So obviously, the decision around, or the anticipation around the 232 announcement in the U.S. that potentially there would see some tariffs come into place, saw a huge dislocation between the COMEX and the LME in terms of the price of copper. Realistically for BHP, we only sell 3% of our revenue is actually generated from the U.S. And so what we saw was actually strong demand in other parts of the globe. In point of fact, China's copper demand increased by 8% over the last calendar year, which meant that we were able to sell freely anywhere in the globe.
Rag, potash is your latest addition to your portfolio and business. The takeover that was happening in Canada, is that complete? And also, how are you looking at the revenues already flowing in when it comes to potash as a business?
Potash, we remain convinced, is actually a commodity that the world will continue to need as the world's population increases. The reality is that more people will need more food, higher living standards will require better food as well. And all of that is going to need fertilizers. And against that overlay, we look at potash as a commodity that we see having huge potential in terms of growth moving forward, which is why we've invested so heavily into potash in Canada. We believe Jansen is an asset that will be around for the next 50 to 100 years. Now, in terms of tariffs on potash, we're not seeing any impact on that at this point. Under the USMCA, there's no implication in terms of potash going into the U.S. And in other areas of the globe, I think there is a high demand for potash that doesn't seem to be impacted so far at this point.
Rag, since I have you with me, cannot let you go without understanding if there are any more acquisitions that BHP is negotiating at this point in time in various assets that you hold.
Look, I think the most exciting thing about BHP is the strong results and performance we've delivered for this year, and also that growth pipeline that I've mentioned to you in terms of copper globally and what we're bringing forward in potash over the next couple of years. This is an exciting space to be.
It sure is. I also want to understand on what your price outlook really is for some of these metals. Copper, for one, we've seen all-time highs in US and then it's come crashing back down, 21% down actually on a month-on-month basis. Iron ore prices in the meanwhile have been under pressure for some time now because of the Chinese data. Are you looking at higher copper prices from here, especially given the fact that most banks and brokerages believe that we could be looking at all-time high in case of copper in this year and the next as well?
So in terms of copper, we remain very bullish based on exactly what we were talking about earlier in terms of very strong demand globally and supply looking to be in balance or even potentially a bit of a shortfall. So we think that positions us well and also sets us up for a future given our natural endowment. In terms of iron ore, I think it's important to recognize that our iron ore expectations in terms of China, in China's steel production, was that we would hit that billion-ton plateau. And that would persist for a number of years, probably starting to curtail a bit in the 2030s. What we're seeing at this point is that billion-ton threshold we're seeing in steel persists, and there is still plenty of demand for iron ore in China and other parts of the globe as well. So at this point, the prices are sitting just over $100 a dry metric ton, which is a very competitive spot to be in, particularly with our cost of production sitting C1 cost at $17.29.
Point taken. Rag, a final question, and this one is on India. And there is a strong trading partnership that you have in India with various Indian companies as well. How would you look at the overall market right now, especially when India seems to be tackling that tariff uncertainty, 25 or 50%? Also, what is your sense on the demand growth trajectory for India from here?
I think India is probably one of the most exciting country in terms of growth that we're seeing. both in terms of the pathway and the projection moving forward. So when I look at the abundance of labor, the ambition that sits in that country, and the domestic consumption that's built there, there is a hugely exciting pathway there as we take a look at India moving into being the fourth largest economy we expect during this calendar year. Now, I do note some of the tariffs that you mentioned, but the reality is India's economy is so domestically based that when you take a look at how exports to the U.S. actually import GDP, that's only about 2%, 2.2% actually, precisely in terms of the GDP generation, and only 1% of that, so 50% of the 2%, 1% all up would be impacted by those tariffs, which to me sends a strong signal that India is well positioned, and it is a country that we are doing a lot of work with, both in terms of copper and also to help grow that steel industry.
Point taken. Rag, thank you so much for joining in. Well, that's the BHP top boss telling us that India continues to be a very strong space therein. And as he explained to us, the GDP numbers really do not seem getting very impacted there. As far as the metals go, well, copper could see all-time highs. Iron ore seems supported at around $80 to $100 a ton there. And well, yes, strong demand continuing globally, not just for copper and iron ore, but for potash as well, is the word coming in from BHP. But with that, that's all the time that we have on this episode of Big C. Thank you for watching.